All right, let's talk about 2026. What's the investment landscape going to look like? It's a huge question, right? Well, today we are going to cut through all that noise. We're going to give you a super clear guide based on what the experts are saying to help you build a smarter portfolio for the year ahead.
So let's turn it back to you. What is your plan for 2026? I know. That question can feel pretty overwhelming. But stick with me, because by the end of this, I promise you, you'll have a solid framework to start building your answer.
All right, you ready to dive in? Here's what we're covering. First, the big picture, the economic outlook for 2026. Then we get to the fun stuff, the top investment opportunities out there. After that, we're going to make it all about you and how to build a plan that actually fits your life. And we'll wrap it all up with 3 simple, timeless rules for success. Let's do this.
Okay, first up, let's talk about the economic outlook. You got to understand the world we're investing in, right? It's the foundation for everything else we're going to discuss.
So, what's the big forecast for 2026? Well, think steady, not spectacular. We're looking at moderate, stable growth around the world. It's not a rocket ship, but honestly, that can be a real sweet spot for investors who are disciplined and not just chasing the next crazy trend.
And here's a really big one to keep an eye on. Interest rates. The general thinking is they're likely to gradually come down. Now, why is that such a big deal? Well, for starters, lower rates make it cheaper for companies to borrow money and grow, which can be great for stock prices. But here's the other side of the coin. For bond investors, it can mean the value of the bonds you already own actually goes up. So yeah, it's kind of like a potential win-win situation.
Okay, so with that economic backdrop in mind, let's get into the really interesting part. Where are the actual opportunities? This is where we're going to look at specific areas and themes that could really shine in 2026.
All right, let's kick things off with stocks, or equities. Look, the tech story is still absolutely huge, and AI, it's way more than just a buzzword now. It's creating real-world productivity boosts, which then fuels the demand for things like semiconductors and all the digital infrastructure behind it. But it's not only about tech. In a stable economy, you also want to look at industrials and cyclicals. Think of cyclicals as the companies that do really well when the economy is humming along. But here's the catch, and it's a big one. Valuations in some of these super popular sectors are, well, they're pretty high. So you have to be smart and think long-term here.
Okay, let's shift gears. I know stocks get all the attention, but seriously, do not overlook bonds. With interest rates expected to fall, fixed income is shaping up to be a really compelling story for 2026.
And here's why it's so interesting right now. It's not just about getting those regular interest payments, which are already pretty attractive. It's that as rates go down, the actual price of your bond can go up. That means you could get capital gains on top of the interest. It's this awesome 1-2 punch for your portfolio.
All right, next up, let's talk about something you can literally see and touch: infrastructure. I mean, think about the huge, once-in-a-generation shifts happening, like the transition to green energy, or the insane number of data centers needed to power our digital lives, not to mention the roads and rails that move everything. Investing here can offer really stable income that's often protected from inflation. But, and this is important, this isn't like buying a stock. These can be less liquid, harder to sell, and have their own set of risks, so you really have to do your homework.
So where in the world should you look? Let's zoom in a bit. The US is still seen as a core part of a portfolio for a lot of people. Why? Because its companies are just crushing it when it comes to AI and productivity. But then you look over at Europe, and the story is a bit different. It's more about value. You might find some fantastic companies that are just cheaper. Plus, you have these really specific themes playing out there, like in defense and their own massive energy transition.
And you absolutely can't forget about emerging markets. I mean, countries like India are just considered long-term powerhouses. You've got these incredible demographics, a young, growing population, and a powerful internal growth story that doesn't always depend on what's happening in the rest of the world.
Okay, so we've talked about the what to invest in. Now for the most important part, the how. How do you take all of these ideas and actually build a plan that works for you?
And honestly, it all boils down to your personal risk profile. You have to be real with yourself here. Are you a conservative investor? If so, your number one job is protecting your money. So you'll probably lean into high-quality bonds and dividend stocks. Or maybe you're moderate. You want that classic blend of growth and safety, so you're mixing stocks and bonds. And then there are aggressive investors. You're okay with the roller coaster ride for a shot at higher returns. You're the one looking at those thematic funds. You know, the ones that are all in on a big idea like AI, or putting more into emerging markets.
Okay, we're almost there. No matter which of those camps you fall into, there are a few timeless rules that just always work. Let's quickly go through 3 of the most important ones.
Rule number 1, and this is the big one: diversify. I know you've heard it a million times, but seriously, don't put all your eggs in one basket. Spreading your money across different types of investments, different industries, different countries, it is your #1 defense when one part of the market goes south. It truly is the closest thing to a free lunch in the investing world.
Rule number 2, make it about you. It is so easy to get swept up in the latest hot trend, but a winning strategy isn't about chasing hype. It's about building a plan that fits your goals and your comfort level with risk. The goal is to build a portfolio that lets you sleep at night, not one that has you checking your phone every 5 minutes.
And rule number 3, keep it simple. Look, let's be honest. Trying to pick the next big winning stock is an incredibly difficult game. Even the pros struggle with it. For most of us, using things like mutual funds and ETFs is just a much smarter, easier, and frankly, way less stressful way to get that diversification we were just talking about.
Wow. Okay, we've covered a ton of ground, haven't we? From the big global economy down to the nitty-gritty of building your own plan. So let's end right back where we started, with that one big question. Is your portfolio ready for 2026? The great thing is, now you have the framework and the tools to figure that out for yourself.